Hey everybody, this is Colby Dotson, and I'm the Associate Wealth Advisor at Boyd Wealth Management. Thanks for joining my first video post to the company blog. Today I'll be discussing the taxation of Social Security benefits and the Social Security Tax Torpedo. I assume most of us know that we pay into the Social Security Fund during our working years through payroll taxes. But I imagine less know once you claim Social Security, there's a good chance you'll be taxed on those benefits as well. Social Security benefits were exempt from federal income taxes from the time the Social Security Bill was signed in 1937 until the early 1980s. Notably, these tax thresholds have never been adjusted for inflation and remain unchanged since being introduced. As a result, it's estimated that 3 times as many recipients now pay some amount of taxes on their benefit. Depending on your combined income, also known as provisional income, anywhere from 0 to 85% of your Social Security benefit can be subject to federal income taxes. It's important to clarify that this doesn't mean an 85% tax rate. Rather, up to 85% of your benefit may be taxed at your specific ordinary income tax rate, such as the 10, 12, or 22% brackets. Social Security benefits are taxed similarly to income from IRA distributions, rental income, and pensions. So as you can see in the table on the slide, if you're single and have combined income below $25,000, you would not owe taxes on your benefit. For joint filers, that threshold increases to $32,000. If you're single and have combined income up to $34,000, then up to 50% of your benefit could be taxable. For joint filers, the threshold is $44,000. Then if you have income above $34,000 as a single filer, up to 85% of your benefit can be taxable, and for joint filers, that threshold is $44,000. Before we get too far into the presentation, it's important to understand that joint filers with combined income over $95,417 and for single filers with combined income over $87,182 in 2024 will already have 85% of their Social Security benefits taxable and will be essentially phased out of encountering the tax torpedo further when generating additional dollars of taxable income, which I'll explain further momentarily. If you're fortunate enough to exceed these thresholds, the information that follows is useful, not applicable for your specific situation. Okay, with that being said, you may haven't noticed, but I've been using the term combined income, which is not a well-known measure of income because it is used sparingly in the Internal Revenue Code. Here's how it's calculated. The IRS defines combined income as adjusted gross income, not including taxable Social Security benefits, plus non-taxable interest, think municipal bonds, plus half of your gross Social Security benefit. If you're following along with your own return or just curious where to find this, I've included a blank Form 1040 for an individual filer below. First, we look at line 11 for AGI and subtract the taxable Social Security benefit found in 6B. Next, you look at tax-exempt interest from box 2A. And lastly, gross Social Security benefits divided by 2 in 6A. You add these together and you will get your combined income. Now, for those who have a blank 6B because you've not received benefits yet, maybe it's your first year claiming, or you want to estimate what your taxes could be on benefits were you to claim. You would add up the individual components of AGI, excluding box 6B, from your Form 1040, which I've highlighted below. Now that we know how to calculate combined income, let's apply our knowledge towards an example. We'll use Robert and Roxanne Retiree, 2 hypothetical clients of Boyd Wealth Management, who have an AGI of $31,365. And what's interesting is that they have $45,000 of total Social Security benefits, but only 17.3% of the benefit was taxable. So how can this be? If we look at their individual return, we can calculate their combined income. AGI in box 11, subtract taxable Social Security from 6B, no tax-exempt interest in 2A, and then half of their Social Security benefit in 6A. You add these together, and they have a combined income of $46,089. Now that we have their combined income, how do we apply it to the Social Security taxation table? I found the easiest way to illustrate this is on a chart. So as we know, For joint filers, the first $32,000 of combined income will not subject Social Security benefits to taxation. However, the next $12,000 of combined income will subject up to 50% of Robert and Roxanne's benefits to ordinary income taxes. Since their combined income exceeds this 50% tax threshold, the easiest way to calculate this is to subtract $44,000 from $32,000 and multiply by 50%. It's important to note that if joint filers' combined income equals or exceeds $44,000, at a minimum, $6,000 of their benefit will be taxable. Now, Robert and Roxanne are slightly in the 85% threshold, so you simply subtract their combined income from $44,000 and multiply the difference by 85%, as I've done to the right of the chart. You add these two numbers up to get the amount of Robert and Roxanne's benefits that are subject to taxation. Now, for individuals like Robert and Roxanne that do not quite have 85% of their benefit subject to income taxes, they are in a difficult spot called the tax torpedo. Here's how that works. Robert and Roxanne are squarely in the 10% federal income tax bracket. And if they were to take a $10,000 IRA distribution for a vacation trip, possibly due to their RMDs or required minimum distributions, you would assume their AGI would simply increase by $10,000 and their tax liability by $1,000 based on their bracket. However, that's not the case because for every additional dollar of taxable income generated, more of their Social Security benefit gets sucked into their AGI. You can see by generating $10,000 of additional ordinary income, 36% of their Social Security benefit is now taxable. Their AGI increases by $18,500 and their total tax liability by $1,850. There's two ways to look at why they've increased by this amount. The first, for every dollar of income generated, their taxable income increases by $1.85 and is taxed at their 10% marginal bracket. This consists of $1 of their IRA distributions and 85 cents of their Social Security benefit now pulled into their AGI. And the second, every additional dollar of income is taxed at 18.5%. 10% on every dollar of their IRA distribution, and 10% of 85 cents of their Social Security benefit now considered taxable. Due to the tax torpedo, Robert and Roxanne are in a situation that will ultimately lead to a higher effective tax rate. It's important to keep in mind that if you fall within the range of combined income that's subject to the torpedo, generating additional taxable income or taking distributions from a retirement account will subject you to significantly more federal taxes than anticipated. Candidly, avoiding taxes on your Social Security benefits and managing the torpedo is going to be challenging, particularly since the tax tables have not been adjusted for inflation. If you're a joint filer, the likelihood of encountering the tax torpedo is high, as most will have two Social Security benefits plus additional sources of income like required minimum distributions or pensions. This highlights the importance of proactive planning with an advisor before Social Security eligibility and retirement to reduce the impact taxes will have on your long-term plans. Strategies like Roth conversions during low-income years before claiming Social Security and tax-efficient withdrawal methods can help reduce your lifetime tax liability. We enjoy working through these types of details with our clients, so if you have any questions about your specific situation or just want to talk about taxes and retirement, please don't hesitate to reach out. Thank you.